All right, when you think about real estate gold mines, what pops into your head? I'm guessing it's the huge skylines, right? New York, San Francisco, maybe Austin. But what if I told you that the real action, the most consistent, solid growth, is actually happening in places you'd probably never guess? Yeah, let's get into this, because the data tells a fascinating story where the little guys, the underdogs, are really winning big. All right, so here's how we're going to break it all down. First, we'll get a handle on what these tertiary markets even are. Then we'll dig into the simple supply and demand that's making them tick. We're going to follow the money trail, try to figure out why Wall Street seems to be missing the memo, peek into the future, and then wrap it all up by rethinking the entire real estate map. You know, for the longest time, the thinking in real estate was super simple. Bigger is always better. If you were a serious investor, you went to the major markets. That's just what you did. But that whole idea, it's getting completely flipped on its head. Okay, so what exactly are we talking about when we say tertiary markets? First off, let's be clear what they're not. These aren't just seasonal vacation spots or those Zoom towns that blew up overnight. Nope, we're talking about smaller, really resilient cities that have their own strong, independent economies. Think places like Savannah, Georgia, or Boise, Idaho. Cities that were already on a steady growth path way before the pandemic ever hit.
And this right here, this is the key difference. The major markets, they get all the press, all the headlines. But with that comes these huge waves of new construction and a ton of that boom and bust volatility. Meanwhile, the tertiary markets, they've been kind of flying under the radar, delivering steadier growth. And here's the kicker. They have way less new supply being built. So, okay, how does that actually turn into success on the ground? Well, it's not some kind of magic formula. It really just boils down to the most basic rule in all of economics: supply and demand.
Okay, take a look at this because the chart tells a really powerful story. At their absolute peak, the big 50 markets were adding new apartments like crazy, at a rate of 6% of their total stock. But these tertiary markets, they never even got to 5%. And now, look where they are, building at less than 2%. What that means is there's this natural lid on new supply, which just makes for a much tighter rental market. And what's the result when you have solid demand but not a lot of new apartments being built? Well, you get this: stronger performance. And I want you to really see this. It's not just a Sunbelt story or a Southern thing. We're talking every single region of the U.S. The Midwest, the Northeast, the West, you name it. For the last 5 years, tertiary markets have beaten the big cities on rent growth. And we're not just talking about a slight edge here. This is a dominant trend. Get this. Of the top 20 best-performing rental markets in the entire country over the past 5 years, an absolutely staggering 16 of them were these smaller tertiary markets. That's just wow.
And just look at this list. It's all over the map, literally. You've got Atlantic City, New Jersey, sitting at number 1. Then you have Knoxville, Tennessee, Grand Rapids, Michigan, Bakersfield, California. This proves it's not some regional fluke. It's a genuine, nationwide pattern, and it's all being driven by those solid, local economic fundamentals.
Okay, so the performance is obviously there. The logical next question is the money following? I mean, the old criticism of these smaller markets was always about liquidity, right? That they were hard to get into and even harder to get out of. Well, that whole narrative is changing, and it's changing fast. This timeline just lays it all out. Back in the 2000s, you can see these tertiary markets were pulling in, say, 12 to 14% of the total investment pie for apartments. But just look at what's happened since 2020. That share has practically doubled. We're now talking 22 to 24%. Consistently, the capital is absolutely flowing in. And we can see exactly where that capital is landing. I mean, look at Charleston, South Carolina. It is punching way above its weight. We're talking 6.7 times billion dollars in apartment sales in just 5 years. To put that in perspective, that's a full $1 billion more than the number 2 market, Sarasota. These aren't little side projects anymore. These are becoming major investment destinations.
So naturally, what happens when all this money starts chasing the same deals? The price to get in goes up. You know that discount you used to get for investing in a smaller town? Well, that's shrinking. In financial terms, the cap rate spread has been cut almost in half. A cap rate is basically your expected annual return. So when that gap shrinks, it means big investors are seeing these smaller markets as way less risky and more valuable, almost on par with the big cities.
But here's where it gets really interesting. It's kind of a paradox. You've got this amazing performance, you've got investment dollars pouring in, and yet Wall Street, a lot of the big institutional players, they're still skeptical. There's this huge disconnect between the reality on the ground and the perception up in the boardroom. And you know what that disconnect means? For other investors, it can spell a massive opportunity. Ann Olson, who's the CEO of Centerpace, really nails the two main reasons why. First, she says that old idea about them being illiquid, it just sticks around, even though the data shows things are getting much better. And second, and this is key, these markets don't have that simple, flashy growth story. Wall Street can't just say, oh, that's the next big tech hub, even if the local economy is an absolute rock.
And this North Dakota story is the perfect example of that disconnect. Wall Street looks at it and says, what's the story here? But the reality on the ground, it's incredible. You've got rent growth over 5%, occupancy is basically full at 97%, and it's being fueled by this quiet boom in high-tech jobs, things like drone programming for the government. The numbers are screaming success, but the story just isn't loud enough for some people to hear. And that gap between the spreadsheet and the story, that's exactly where a smart investor can find a real edge.
So that brings us to the big question, right? Is all this just a flash in the pan, a temporary thing? Or are we looking at a fundamental, long-term shift in the market? Well, let's see what the forecasters at Oxford Economics have to say about the next 10 years.
Okay, let's really look at this. When you check out the forecast for population growth, yeah, you see the usual suspects like Austin and Dallas. But look closer. 6 of the top 10 fastest growing places in the entire country are projected to be these tertiary markets. St. George, Utah is number 1. Lakeland, Florida is up there. The people are moving, and the momentum is clearly shifting to these smaller cities. And if you thought that was something, the story for job growth is even more dramatic. I mean, really let this sink in for a second. According to Oxford Economics, an incredible 9 out of the top 10 markets for future job growth are tertiary markets. 9. From Provo, Utah, all the way to Fayetteville, Arkansas. This is basically saying that these smaller economic engines are the ones that are going to lead the entire country in creating new jobs.
So, okay, when you stack up all this evidence, piece by piece, it really forces you to just throw out the old real estate map and start rethinking where the real opportunities are today.
Let's just recap the whole argument because it's pretty powerful. 1. They have way less new construction, so supply is tight. 2. That's led to better performance, higher rent growth all across the country. 3. The smart money is noticing and pouring in, making them easier to invest in. And 4. The future looks incredibly bright, with forecasts showing they'll lead the way in both population and job growth.
So what does this all mean? What's the big takeaway? For decades, we've been taught that in real estate, safe means big. But all the data we just looked at, from past performance to future growth, it shows that these smaller, often overlooked markets are the ones that are proving to be incredibly resilient and dynamic. So it really leaves us with a huge question to chew on. Is the very definition of a safe real estate bet changing right here, right now?